Good morning, all. Thank you very much for joining BNY Mellon and Aligned Business Advisory Services for a informative dialogue on creating generational wealth, with M&A as being a key component within that opportunity. I'd certainly like to lead things off with introductions, first and foremost through our collaborative partners at BNY Mellon today. I'd like to hand it off to Scott Barron to provide a little bit of background on his role and position within the firm, as well as how he supports clients.
Okay. Thank you, Tim, and thank you all for joining today. My name is Scott Barron. I'm a senior principal at BNY Mellon, helped lead our office in Orlando, Florida, and really am the team leader for all of our high net worth business owners that we work with pre and post sale, providing them a collaborative relationship to really address all areas of concern going through the M&A process. So we're appreciative of you joining today and look forward to the conversation. Tim, I'll turn it back over to you.
Great. Thank you very much, Scott. Much appreciated there. And Scott's colleague, Keith, is another member of the team here today that will be discussing the different strategies appropriate. Keith, would you mind sharing a little bit about yourself as well?
Sure. Good morning, everyone. I would say the vast majority of our clients find us through a business transaction. And so when we start engaging with those individuals, we like to preview a little bit of what's to come. And I'm one of the individuals on the team who focuses on the quantitative side of planning for wealth, passing it along generationally, minimizing transfer taxes, all of those hot topics. So excited to be here today and look forward to diving into some of those themes with y'all.
Excellent. Thank you very much, Keith. And Craig, why don't you bring us home from the Aligned Business Advisory side of house, please?
Yeah, sure. Thanks, Tim and Scott and Keith. Appreciate you guys jumping on here. And this is going to be a nice educational opportunity for the folks on the phone to understand a little bit more about creating generational wealth, particularly through mergers and acquisitions. You know, Align is an M&A focused advisory firm that focuses primarily on entrepreneurs, family-owned businesses, and management team-owned businesses, and really to provide liquidity events, multiple liquidity events for those owners of businesses that have created significant wealth and have a significant amount of wealth in their business. And so happy to be here today. As I mentioned earlier, managing director of Align from the deal origination side. And Tim Hughes is one of our directors on our team that spearheads a lot of the strategic partnerships, and more importantly is a great director from the M&A side and a great advocate for his clients.
Great. Thank you, Craig. Appreciate that. And to Craig's point, another member here at Aligned Business Advisory, I'll be moderating here today's session. And as we make our way into today's dialogue, folks that do have thoughts or questions along the way, please feel free to share those within the chat. Those will come directly to us and we'll get those fielded as best we can towards the end of the session. But we thought today would be really useful in trying to silo and break down really the three big phases and pillars within today's dialogue. And I think first and foremost is going to be educational background, and really what is generational wealth, how can that be achieved, and certainly how can that work for families both in the near and long term. Following that up with really the market dynamics of what is going on in the marketplace today for our founders, for our business owners, and certainly the opportunity that's in front of them. And then really following that up with how to achieve that. How do we really monetize our life's work? And then how does that feed into the generational wealth platform that we're emphasizing here today? And so certainly between the three gentlemen here that we have on the bridge, we're looking forward to sharing those thoughts and insights, and at least provide some good guidance on how to achieve that going forward. So without further ado, we'll kind of get things kicked off here today. And I think really that Keith over at BNY is going to be a key cog here, discussing really at a grassroots level, what is generational wealth? What does that mean to the average Joe or Joette? And certainly if you could, Keith, lead us in there.
Yeah, thank you, Tim. So when we start with someone who's thinking about having a liquidity event, really of any kind, we like to talk them through what that journey looks like and begin with the end in mind. When you can visualize what the path of having generational wealth and liquid wealth looks like, you can start to prepare for those twists and turns along the road in advance. And really, by doing that planning from the very beginning, oftentimes individuals and families are much better off. And so how do we measure that? What do we mean by that? Well, we see 4 distinct phases in managing generational wealth. And what is generational wealth? It's money that you really can't spend. And a lot of people, when they're running their business, they understand the vicissitudes of being in a private business, being responsible for the income that they generate annually, having years where there is an income, having years where they earn much more than they expected. Having liquid wealth takes a lot of that volatility off the table. But a lot of times people don't know how much they really need. How much is enough? How much do I need to replace my income, my spending levels, perhaps inclusive of things they had been expensing through the businesses? All of that is that initial transition from building and growing wealth to understanding and enjoying it. After you get through the due diligence process, cross the closing table, and see an account that's funded with a large dollar figure, all of a sudden it becomes a question of how do we really just take a moment and celebrate what got us to this point, enjoy a little bit of that creative transition event, and then really understand what comes next. So how much do we really need to carve out for our lifestyle spending? How much risk can we afford to take? How do we think about tax and fee efficiency and the way that we're really leveraging our global balance sheet? You know, we find that a lot of our investors and clients don't understand the role that debt can play on their balance sheet because the conversations around debt are completely different when you are a liquid investor rather than an entrepreneur. In many ways, it can be difficult to get capital when you need it the most, when you're building and growing wealth. But our clients use debt really as an asset class. They use it strategically. They use it to be an opportunistic buyer when others don't have cash on hand during market dislocations. You can see what rising interest rates have done, even to start creating some opportunities in the market now where business assets transition from weaker hands to stronger hands. It's really nice when you're in that position of liquidity and have a generational portfolio to be able to leverage an investment credit line to then all of a sudden sit on the other side of the table, become that strategic buyer and that strategic partner. But just like any business, managing wealth is its own business. And as we like to say in our industry, a lot of folks don't necessarily realize that they're not actually selling the business they created. They're trading one business for another. And that's where the next 2 phases come into play, preparing and transitioning the wealth to the next generation. Most of our clients will leave all or a portion of their assets to their family. Many have charitable plans in their wishes that they fund either during lifetime or at death. But regardless of who your ultimate beneficiaries are, you need to prepare them to manage that wealth and appropriately transition roles of control, just like you would in an operating business. Even wealth needs a succession plan. You need your trustees to be identified, the executors in your will. And beyond simply naming and filling those roles, you need to prepare the individuals who are going to have those positions of responsibility and authority to understand what is needed to really carry out those roles efficiently. We spend a lot of our time at BNY Mellon educating the next generation in concerts with the wealth creators to give them a sense of not only the work that it took to create the wealth, but what it looks like to be a responsible steward of wealth, to enjoy it, but also leave it in a better place than you found it for the next generation's benefit past them. And finally, the last phase is actually after the wealth creators are gone. It's trusting that the plan works and realizing the impact that you want it to have in the world, again, be it family, charitable, or otherwise. So if you know what the end of the road looks like, how do you start using that planning to your benefit today? Well, a lot of people don't realize that actually they can start preparing for that trust and impact phase and for the management of their wealth before they've actually even got an LOI in place and are thinking about transacting. That's a great time to engage us. So Tim, if you want to flip over to the next slide, we spend a little bit of time on defining what is core versus excess capital. This is an incredibly important first step in knowing that you are ready to transact, that this is the right moment for your family to take that next step, because you understand that you have enough core capital in what the business is worth on paper to be able to completely replace your lifestyle spending along with some personal reserves for extra comfort. So what is it? How do you define core capital? Well, a quick rule of thumb is 3% of the portfolio as a distribution annually is sustainable and will grow with inflation. It's a very conservative definition. And I'll tell you, we have lots of wonderful software that can make that definition much more complex. But for today's conversation, I think 3% is an easy number to plan with. So if you're currently spending or taking from the business about $500,000 net of tax per year, that means you need about $15 million in portfolio to never worry about your lifestyle spending. Of course, we typically run this analysis several different ways and specifically for each of our business owner clients. But if you think about that as a guardrail, then perhaps if you know that you could net $30 million from marketing the business and you only need 15 to meet your lifestyle spending, that puts another 15 million in that excess capital bucket. And I personally define excess capital as wealth. That is the amount of assets that you actually don't need, that you will never touch or spend for your generation. So it goes to discretionary spending, that beach or mountain house that you always wanted but hadn't planned for, or other special major purchases that you may have up front. It can also be directly gifted to your children. You know, a lot of people want to support their children's education, maybe their first wedding, perhaps a down payment on a house, or planning for future generations, knowing that the children need to get the assets, but perhaps they're too young or they're not in the right stage to get that today. Well, what we realized when we looked at our business owners' balance sheets is they oftentimes have a component of rollover equity in a transaction. Rollover equity is a great asset to plan for when it comes to leaving assets to children without giving them cash today. A lot of times before there's an LOI in place, we can help along with outside counsel and tax consultants to plan for what does it look like to give the rollover equity away before we actually have a valuation on the business. Can we make that a minority interest that's non-marketable so that now we can use some discounting and take what the IRS gives us as the exclusion amount from estate tax and actually carve that out for the children today at a value that's going to be much lower than what that rollover equity is worth at the second exit. I know Tim's going to spend quite a bit of time talking about planning for that rollover and really the power of it.
Absolutely, Keith. And that's really, really helpful context today where, you know, from a planning perspective, how great of an overlap that is from an Align M&A perspective. And I think first and foremost, Craig will go into great detail here on really what that conversation looks like in the early days. And it has everything to do with, you know, what sort of lifestyle, what sort of outcome are you all trying to achieve? And Craig, I think that would be a great opportunity for us to kind of jump in and identifying really at the root, you know, what M&A can be for a family, and then having that maybe lead into kind of the market dynamics that we're looking at here today.
Yeah, sure. Absolutely. Thanks, Tim and Keith. That was excellent. And really set the stage for, you know, M&A and how that can frankly define a family and create generational wealth. And obviously you have to have good stewards to be able to ensure that those dollars are, you know, preserved and are, you know, accounted for appropriately. But when you think about M&A and the opportunities that are bound for businesses in today's marketplace, you know, today, particularly for lower middle market companies between, you know, call it 10 and 200 million of revenue and obviously cash flow positive, there's a significant opportunity. Private equity investors and institutional investors on Wall Street are really focused on high quality businesses that are, you know, less cyclical to the overall economy, and that are, you know, perhaps service-based businesses in particular. And what we're seeing is we're seeing, you know, obviously last year and into early parts of this year, there was some instability in the markets and a bit of market tumult. But, from the private equity perspective and in the private markets, stability has endured. And, now these institutional investors have greater line of sight into, potentially what the terminal Fed funds rate is going to be, despite it, potentially being 50 to 100 basis points higher than where it is today. Regardless of that, deals that are of higher quality, family-owned businesses that are of good quality and cash flow positive and stable are, very, very much demanding a premium in today's market. Last year saw in 2022 was the biggest ever fundraising or the second biggest fundraising for private equity in history, only second to 2021 when there was quite a bit of stimulus money from the federal government. So, what we're seeing is a very nice influx of capital into the private markets, and the private markets continue to expand. And these institutional buyers, these private equity firms are looking for well-operated family-owned businesses that have a strategic niche to them and perhaps a bit of a moat around them in terms of their competitive advantage. And so what that ends up happening is you have a lot of high quality dollars chasing a lot of high quality assets. And so, for families, particularly that we serve and then the BNY folks serve, is they don't know what they don't know. And, our job is really to help educate them on the opportunities that are out there in the marketplace. And then to Keith's point earlier, preserve that wealth for the next generation and beyond. And M&A really is an accelerator to be able to create generational wealth. And Keith mentioned in the back half of what he was talking about of the rollover equity, right? You can sell a portion of your business today, you de-risk yourself, you pull some chips off the table, and then you also still have equity in the business and a smaller piece of a larger pie that has the ability to frankly return just as much as the initial bite of the apple, which we'll get into later. Or more, right? And so, that is an opportunity for substantial wealth creation, and to be able to preserve that and manage that appropriately is of paramount importance.
Craig, and that's very, very helpful and provides, great insight into really what the opportunity could be today. I think what would be great to hear and get a better understanding on is really what is that strategy today of what we're finding from the buyer community that, we hear so much about the buy and build strategy that I think applies really well to the sort of clients that each of us support here today. If you wouldn't mind, go into kind of what that looks like and what that means for the owners that are out there today.
Yeah, excellent question there, Tim. And I think if you flip to the next slide, it'll talk a little bit about more of that buy and build strategy. So when you think about buy and build strategy, what does that mean? So private equity businesses and what we call a platform private equity businesses are larger companies that effectively gain scale by buying other smaller businesses in the same space. And so what we've seen actually over the last year, 2 years is the buy and build strategy is fundamental to the PE playbook, but more importantly has increased as a percentage of total buyouts. You can see on the left side of your screen here, the turquoise and blue has elevated and has elevated over the last handful of years, but more importantly is now at 80%. In 2023, that's exceptional. Typically, it was about 60%, 55 to 60% historically. And so again, what you're seeing is private equity increase obviously in their share of ownership of businesses that are entrepreneur based or family owned based, and it's providing opportunities for these businesses to continue to grow and scale and be able to continue on the legacy of the founders. So it's a fundamental opportunity and very, very nice opportunity for these lower middle market, these small businesses, these call it Main Street businesses to be able to find liquidity and provide liquidity to their family while de-risking themselves. And then also, planning for the next generation and then the generation after that and putting a plan in place to preserve that capital for the business that, frankly, may have been handed down to them and create that legacy and that generational wealth through the blood, sweat, and tears that these business owners have put into their business.
Right. And Craig, I think that also speaks to, really emphasizing who this can really apply to. And I think for so long, opportunities like this really felt out of reach for a lot of the business owners today that, started with, one person in a truck and over time have built into a wonderful business, with 10, 20, 30 trucks and 60 people, employed. Where so much of the buyer community now is emphasizing these sorts of businesses because of their resiliency, their strength, and their dependableness as far as supporting the communities and the robust business that they've operated here today. So outstanding in that regard. I would wonder, Craig, maybe painting an additional picture on that profile. What are we seeing? What are characteristics that we find to be in such high demand from the buyer community?
Yeah, just a couple of things there before I get into that, Tim, and you hit on it, is the opportunity that private equity or institutional investors bring. I think historically it's been the big bad gorilla that somebody is going to buy your business and tell you exactly what to do and squeeze margin, and everybody is, your employees are upset and all this and that, and that's, while there is some merit to that, that's not been the last 5+ years of institutional and private equity investors investing in businesses, particularly for service-based businesses. When you break it down and you think about the value of a business, really it's about the protocols and the practices and the procedures they have in place, right? And the duplicity of if that senior leader left today or tomorrow, or God forbid got hit by a bus, does the business continue to operate? And that's really truly the value of business. And so these institutional investors understand that, and they value that. And so they're not coming in here to tell you what to do or tell your employees what to do. They're literally coming in and effectively giving you a blank check to say, how do we grow this thing to the next level, right? A lot of entrepreneurs hit a growth ceiling, or they put too much on their shoulders. These institutional investors give you the ability to pull some of that more financial management, administrative, back office type of work off of your shoulders for you to focus more on strategic growth and strategy, to be able to take the business that may be at 10 million or 15 or 20 million to 40 or 50 or 100 million, right? So that's the playbook of these of private equity and institutional investors in today's marketplace, and the opportunity is abound for these Main Street businesses, these service-based businesses. We do quite a bit in industrials, business services, and healthcare, and these are your Main Street businesses. These are your HVAC providers. These are your manufacturers. These are your physicians that you go see, right? And there's opportunities out there that are highly prevalent for these business owners to be able to, again, pull chips off the table and be able to have a partner with them that's invested alongside of them, and not telling them what to do and micromanaging them, but more importantly, helping them achieve the next level of growth and opportunity for not only for their business, but for their employees' sake, and also for generational wealth for that family in particular.
That's helpful, Craig. I think one thing we probably want to emphasize here as well is how much our business owners are in the driver's seat here, as far as identifying and selecting partners, as opposed to selling a home where you generally take the highest bidder, and regardless of what you think about them as people and whatnot, that's very much different here under this pretense. Craig, maybe go into for a business owner what that can look like as far as identifying and selecting a partner.
Yeah, it's incredibly important, and I know Scott and Keith will talk a little bit more about structure of an opportunity and how that parlays into wealth preservation and wealth management. For us, structure is critically important, fit's critically important. Obviously dollars are important, but there's value to the right fit and selecting the right partner. And frankly, I'd say 80 to 90% of the deals that we do on an annual basis, which is just typically call it 30 on average, 80 to 90% of those deals don't go to the highest bidder. They go to the partner, frankly, not the buyer, the partner that's going to be able to elevate the business to the next level, and really create that true partnership. It's not just, hey, I work for, institutional investor or private equity firm or fund now. It's no, these are my partners, and we're going to the next level of growth. So selection of partners is critically important. And it's having a good advisor on your side to be able to present those opportunities to you and be able to really try and narrow the valuation gap and preserve those dollars, right? Let's not be cliche here. Dollars are certainly important. But at the end of the day, when the deal closes, you still got to put your pants on and go to work the next day. And you got to make sure that you're with that right partner that you like. And frankly, that you trust, and that's going to elevate you and your business and your family and your employee and your employee's family to the next level.
Great, Craig. Thank you very much. And I'll quick little reminder for folks out in listening in here today. Don't be shy about questions. We'll be looking forward to getting those addressed here at the end of our session. So if something comes to mind, pop it over, and we'll make sure to get it answered here towards the end of the session. I think, Craig, that's a great opportunity to kind of pivot and bring the BNY folks back in, where so we've really laid out, what is generational wealth? What does that encompass here today? We've kind of talked about the broader sort of macro M&A environment, what that opportunity can look like, how that can work for our business owners here today. I would then maybe go back here into Scott, and what we'll probably do is do a bit of hopscotching back and forth between the BNY team and Align. And as you all have these business owners that you're supporting today, what are some of those early questions that you're asking of those folks to ensure that they're in a great spot, both at a personal level, and then obviously Craig will jump in and discuss what that can look like at a business asset level.
No, thanks, Tim. I can take that piece on the personal side. Really, it's oftentimes our business owner clients are so involved in their business, they haven't really taken time to really do the personal financial checkup. So the number of business owners that come to us without even a will, or a will that has been updated in the last 20 years, that's kind of basic starting conversations for us, is what happens tomorrow if you get hit by the proverbial bus. What happens to your kids? How do we make sure that this transitions to your next generation efficiently? So it really starts out with the overall wealth plan. We view wealth management as so much more than just managing your stocks and your bonds and getting a great return. It's really about getting your financial house in order and really developing an owner manual for your wealth. Similar to how you build an owner's manual for your company and operating procedures, we want to build that separate wealth entity for that as well. So I think that's why we have a team of individuals that surround our owners. And Tim, if you could just go to that slide, I think that kind of emphasizes the importance of kind of graduating up to really what we call an outsourced family office model, where you're hiring a team to work with you on all aspects of your wealth. So, with us, it's not just, we're obviously going to talk about the liquidity aspect, that core and excess capital. How are we managing that? Going back to what Keith Kellum talked about. But, Tim and Craig and the team at Align are going to do a great job getting you an ideal deal, whether it be with an earnout potential, with rollover equity. How are we planning for that? What does that look like from an asset planning standpoint, ensuring that all your ducks are in a row for that? And then you're really just having a collaborative effort of a team of advisors. We typically see owners, they work with someone that when they first started their business, they may have set up their 401k plan for their employers or employees, and really worked with them on that, but they may have outgrown that person's advisory capacity. And we're blessed to work for a firm that has been around since the founding of our country. As a firm, we custody about a third of the world's assets, which is about $45 trillion. Keith and I sit on our private family side, where we work with families that look like the institutions we serve. Our average deal size we worked on last year was about 21 million of assets, and that doesn't include rollover equity and everything else that the owners have. But we're used to this space. This is what we do all day long. And what we love about our entrepreneurial clients is they need a team to go alongside them, because once they sell that first asset, more than likely they're going to build another asset and try to sell that, whether it be commercial real estate, another business. And having a team of people to go alongside them to help with that, I think, is crucial. And then the last piece, I think, is stewardship. We pride ourselves on being stewards of our clients' assets. Oftentimes our clients, when they sell the HVAC company in their small town in Florida, oftentimes it gets well known in the community. and they are being pitched every type of business idea or investment venture you could possibly imagine. And we try to be that board of advisors that helps advise that client on how, is that a good fit for what your desired goals are? Is it an opportunity for you to become a lender to that project, or do you become an actual equity investor? All those types of things that, really are outside the scope of just a stock and bond portfolio. I think it's what we pride ourselves on. That's why we have a team of people here that really, become employees for our business owner clients. Our business owners are used to people reporting to them daily and going to the office. Once they sell that company, they no longer have those employees. We actually become probably that outsourced employees for them as well. So I'll turn it back to you, Tim. Keith, if you have anything else to add, please feel free to.
No, I think, Scott, you laid it out with, whether it's a will, whether it's other sort of structural components of a specific family. Craig, I think that would probably lend itself to marrying up nicely with, structure within the actual organization, right? Whether it's government covenants, structure, ensuring all shareholders are on the same page. Maybe talk about ensuring a business is well structured before going to market. I think clarity there would be helpful.
Yeah, sure. That's a good segue, Tim. A lot of the first questions or I would say interest that we get from buyers is really keyed in on, what does your middle management look like? Again, I think we talk about this proverbial bus as Scott alluded to, but again, the value of a business is really with the employees. And so key management in place is important. We educate and we learn through our career and our business. And one thing that frankly I've learned over the years is, you really want to focus as a leader and as a business owner, focus on the business instead of in the business. And what that means is to be able to, let the day-to-day go and have operators or key management in place to do that. And focus as a business owner on the business. Think about the strategy. Think about if you had, an endless amount of resources and a blank check, where this business could go, right? And having that strategic vision, that strategic plan, and then presenting that to the marketplace or to Wall Street and the investment community is the way that you have the ability to extract premium value, and more importantly, be able to structure the deal appropriately from a rollover equity perspective into the next business, and frankly, what we call become quote unquote part of the travel team, right, of that larger company. And you're doing the strategy, you're doing the growth, you're focusing on the business, not in the business. And so that's critically important as the folks, the entrepreneurs and business owners on the phone think about how they position themselves for an opportunity for a liquidity event. Obviously, the initial sell is important, and we're talking, selling anywhere between 60 and 80% of your business, and then, rolling over 20 to 40%, or a little bit less, or a little bit more, whatever the desires are of that business owner. But again, having the ability to have that foresight into the future is important. It's tough though. I mean, think about it, right? I mean, a lot of business owners are focused on the day-to-day and everything's going well, but to ultimately be able to achieve great opportunities for not only that business owner's family, but also your employees, takes line of sight into the future, and it's critically important to be able to extract premium value. And then from there, it's really a blank canvas in terms of the deal world and the structure of, effectively what we tell our clients is, the canvas is blank and you can paint it however you want. There are certain things that we'll try and move mountains for you, and we've been successful at doing that, frankly. But it's something that is in the transaction world is an opportunity to position yourself for generational wealth and multiple liquidity events with greater frequency than what you could do by yourself.
And Craig, I think that explanation does such a great job at emphasizing really the collaborative nature of a group like BNY and Align, and how, although organizations separate in nature, the collaboration is so critical in really trying to deliver that client to the end result effectively. And I think, the group here on the bridge, can all attest that if the client wins, everybody wins. And I think that sort of emphasis is important. I think as, a process moves its way forward, it's going to be imperative that, we have a receptive group on the other side that's going to really help accept and field that liquidity event in an effective nature to ensure, long-term success.
I would just say one thing, Tim, on that, because
Please
that's a critically important point. And I would invite Scott and Keith to opine on this, but wealth advisors and advisors like BNY are almost as important as an M&A advisor like us in the deal. Solving for what you're looking for from a quality of life perspective really starts with your wealth manager. And I think the BNY team and the way that they're set up is really kind of your entire family office, and is really solving for the opportunities and positioning you appropriately for wealth preservation and sustained wealth, and then also wealth creation too, right? I think for us it's we're very tactical and strategic in what we do, and that's important as well. But more importantly, you got to have a good partner, a good wealth partner on your side to be able to help guide you and frankly quarterback your life. And I think from a financial perspective, and I know BNY does that quite well with the team that they encompass their clients with. We call it the modern family office, right? And so they're servant leaders to their clients, and that's critically important as you think about things that in terms of selling your business or finding liquidity events. Like, those are very monumental life decisions and milestones, and you got to have a partner on your side that you can fully trust, and that's going to be with you before the transaction, in the transaction, and after the transaction, and then on the next one, right? So Scott and Keith and their team do an exceptional job on that. And so that's something to keep in mind for the folks on the phone that are thinking about, or just starting to think about selling. You got to have a quality partner with you.
Right. And Craig, I think we could take it even a step further where, not only having a single party that you trust, but I think having multiple that are all educating in the same direction with the same philosophy. I think that's only going to provide comfort for these business owners, as to your point, arguably one of the biggest moments in their life. And it's these businesses are a part of each and one of these business owners' soul. It's deep. And so obviously a transaction is a monumental change in that, and ensuring that's conducted appropriately is paramount here. And so I think that probably lends itself as we make our way through a process, and we've got other webinars already on file here that go into great detail on what that looks like. But as we kind of go through a process, we edge our way towards letters of intent. We've selected partners, and we're moving into diligence and closure. That really starts to lead into what life after the deal can look like. And I think, Craig, maybe we start with you on structure of what that can look like for a business owner. And I think, Scott, that likely feeds into what that liquidity event can look like post close, and onto the future.
Yeah, excellent. And I'll quickly kick it over to Scott and Keith here. I think for us, we're mandated obviously to serve our clients. And like I said earlier, it's a blank canvas. So really we work with our clients on what they want their life after the deal to look like. It's something that's critically important and that we solve for upfront in letters of intent, and structure that in advance of signing an exclusive letter of intent or LOI with a prospective buyer, just to ensure there's no ambiguity when we go exclusive and get into due diligence. And nobody likes to waste time, and so we want to eliminate that, or eliminate that as much as possible, and have a high confidence level of this is truly the right partner, and my life after the deal is going to be exceptional. But it's also we solve for what our clients are interested in, and I think that's a lot of times where Scott and Keith and their team come in, and we work directly with them and the client on what do you want that to look like, right? Not only from a cash perspective, how much cash do you need up front? Are you going to roll over equity? Or you're just going to leave the business? Is there an earn out or contingent consideration to it? right? All those kind of like tic-tac-toe, structure of a deal is important, but it's more important from the quality of life and the life after the deal of the prospective, client or clients in this case, and with the buyer too in that partnership. So again, we work with Scott and his team and the client to really solve for that. And then, frankly, the BNY folks take over after that, right? We parachute out. I mean, we're always here, but we parachute out, and that's where life after the deal and wealth preservation and generational equity and wealth is created with the Modern Family Office that BNY serves its clients with.
That's super helpful, Craig. And Scott, maybe that's a great opportunity to pop in here and really talk about, liquidity event, right? Wires across. Maybe talk about, some of the infrastructure and steps you all take to ensure that accepting that liquidity, that big payday for these business owners is done so effectively. And then really that'll likely lead into really the long-term, generational and ideally multi-generational sort of opportunities.
Mm-hmm. Absolutely. If you could, Tim, turn to the typical situation that we see with our owners. Oftentimes we see owners come to us pre-sell and everything is segmented. You have, your liquid assets. If you have any, most of our owners have all their assets tied to their business, but those that don't, they've got that siloed. They've had their CPA or tax planning attorney in a silo. And then any other type of advisors on the generational side. We work with owners that sometimes, they don't even share with their spouses or kids what the value of the business is, anything like that, or even intent to sell. So what we try to do is we try to coordinate all three of those areas into one succinct strategy, really pre-sell and post-sell. But pre-sell, our job is we want to work alongside our partners with Align to make sure that we have everything in order, from your estate plan, from getting heirs prepared, getting employees prepared on the sell, all those types of things, to really even solving for your number. Oftentimes we get to the finish line. I'm sure Align can talk about this even more so, is that owner hasn't really thought about what the actual number is they need for the sell of their company. They oftentimes, are at their trade shows with their partners they've known for a long time, and their best friend that's in the same HVAC company sold their business for 35 million, and Align did their process, and maybe their competitive offer is only 22 million. And so why is that the case? And obviously, there's a variety of different reasons why that could be the case, but if that owner has done the pre-sell planning, preparing for the cash flow, all that, he may realize that he only needs to live off 12 million for the rest of his life because he has a modest lifestyle, whatever that is, and then the rest can be that excess capital that Keith had talked about earlier on philanthropic endeavors, funding kids' businesses in the future, all those types of things. So Tim, if you could just go to the final slide with us, it's really, if we can coordinate and succinct all that together by getting the plan for the liquidity, getting the plan for the capital gains tax that's going to be owed a year from now from the sell of that company. Owners hate paying taxes, but what we also say is if you're paying capital gains taxes, you have done something right with your business. Our job is to plan for that pre-sell, one, to hopefully mitigate that tax, and then post-sell, how do we plan to pay for that tax when it's due the next April? And then the last piece is really helping children, grandkids understand the importance of wealth, the stewardship of wealth. Oftentimes our owners don't want to transact because they are worried about what this potential windfall of cash could mean for their family, because they've been able to live a semi-modest lifestyle while still having a very successful company. What does it mean when you have 25 million sitting in the bank, and your family finds out about that? We come alongside our partners and help with education of children, of grandkids. Why do we have stuff set up in trust? Why are we, making sure our kids are still having great work ethics and going to go start their own types of businesses or go to college or whatever else? Really putting all those structures in place, even pre-sell, really helps when it comes to engaging with Align. And once you go through that process, when you have your personal financial house in order, they do a phenomenal job on the business side of the house to make sure that's in order to get you the most bang for your buck and the biggest dollar you can get and the best deal you can get that fits your family the best. And as they're going through that process, Keith and his team, we do a lot of work on financial modeling, what it looks like to roll over equity versus getting all cash versus earn out, all those types of things, because you'll have multiple offers. And so helping dive deep into all those multiple offers and really what is the best fit for you and your goals that really go back to your original plan as on the personal side, I think will help once the closing table happens and you're getting ready to sign the letter of intent to go through the due diligence phase.
And Scott, that, it was wonderfully laid out. And I think hopefully folks on the webinar here today can understand really how both, Craig, Scott, and Keith are kind of inching this, this thought process through, and each, component, works in relation to the other. And I think, Scott, you're talking about the post-sale here. Craig, why don't we talk about really what, in parallel, right? You've had the liquidity event, but maybe you're an owner that has decided, I'm not ready to retire today. My spouse, won't let me stay at home all day. I need something to do. And so what happens so often is that these business owners are retained within the business. And so even after you've actually sold the business, there's still a phenomenal opportunity to be retained within these organizations to help grow. And then I think that maybe will lend itself into highlighting that second bite of the apple and what that opportunity can really be. And then I think Keith can then pop back in at a liquidity level there.
Yeah, sure, Tim. That's excellent. And it's important, right? So you think about the historical thought process of business owners is, at one point I'm just, gonna lock up the keys to the shop and throw those keys away and sell my assets for salvage value or net asset value, NAV, and go retire to the beach. A lot of what we do is educate business owners on, saying no, there's a better way, and that's through bringing on a partner and selling a portion of your business. And so, when you think about as a business owner, when you think about your sunset years or your years of saying, hey, I really rather play golf or go fishing or hang on the beach with my wife or spouse or whatever it is, you really want to have that thought process be about 3 to 5 years out, because typically in these deals there's an opportunity not only to roll equity, which with Keith we'll get into here in a moment, but also, like I said earlier, be able to work on the business and help grow the business over those handful of years. The typical average institutional investor or private equity hold period is anywhere between, call it 3 to 6 years, with kind of 4 to 5 being that sweet spot. It depends on different life cycles of where that acquiring business is in their ownership. But then they trade up to the next, larger fish in the pond. Think Blackstone, KKR, Carlyle, Apollo, those large private equity firms, or they go IPO, right? And so, I think, what we do with our business owners and our clients is educate them on those further opportunities of saying, hey, you're not going to be running the day to day, you're going to be working on the business, and you have the opportunity to continue to grow it and have a piece of that action. And frankly, from all, when we have our post deal client check-ins, they love it. We just had one last night, and this gentleman is younger and traded his business for a great deal, and is doing exceptionally well and having fun doing it too, right? And the partner that he partnered with is really just asking him, how can we help, and how can we help accelerate your not only growth of the business but also your professional development. So there's a personal piece to it as well, that helps these individuals, these business owners, achieve their next level and think outside the box and just their typical business. But certainly coming back to your question, Tim, it's really, if you're thinking 3 to 5 years out of, hey, I'd really like to dial it back and not, work 100 hours a week in my business. Maybe that looks like, 40 hours or 50 hours. We have a client in OKC that's, working 5 hours or 4 hours a day in the business and is loving it and, doing great work. So, the opportunity there to, again, paint your own canvas is there. And that's what we solve for and work for, those particular clients. But, keep in mind, rollover equity is certainly critically important. If you think about it, in a vacuum, when you sell your business, the basis of your equity in that business is likely near zero or just near the assets that you've invested in. And so if if you invested $1 million in the assets of your business and you sell it for 10 million, that's $9 million worth of equity value. And effectively what rollover equity does for you, for the business owners, it gives them the opportunity to continue to do that just at a larger scale, right? So you enter into a capitalization table of a larger business. You're not going to own, 100% of it. You may own 10% of that business, but that business may trade for $1 billion. And now you're looking at $100 million, right? So, that's the power of rollover equity. That's the power of scale with a financial partner, with an institutional investor, to be able to help you help the business achieve its next level of growth, leave a critically important legacy for the business owner, and then, preserve the wealth for not only your family directly today, but also the next generation and the generation after that. So it's an unbelievable vehicle that just frankly, Main Street businesses may not be privy to. And so that's why, we're on the phone here today to help educate those business owners and those advisors to the business owners. The BNY team does a great job of educating their clients and advising them and finding the opportunities for their liquidity events. But I kick it over to Keith to talk a little bit more about how powerful that rollover equity is and what that can mean for significant generational wealth creation.
Craig, what if I could, Keith, let me pop in real quick, because I think to really lay that out in a simple format, generational wealth is not necessarily created in one opportunity, in one moment. And I think what Craig and the rest of the team are really laying out is you have an initial sale and you have the opportunity for rollover equity, which can be another windfall opportunity of wealth. And so when you look at the total composition of this, it's really two and even can be three-pronged if you stay on with the business. So even if you believe Tim, I'm a small business. I'm 8 or 10 million in top line revenue. I'm 1 or 2 million in EBITDA. This doesn't apply to me. That's not true in the sense that where you can go out and achieve a wonderful first outcome of the sale, it's the rolling of equity, laying out Craig's point of pulling that through. And then that equity, that few $1 million that you've reinvested in the business, then getting its own multiple in that 3 to 6 year period, you can, in many cases, double the initial opportunity. And that's really what we're talking about, that generational wealth level. It's not necessarily the first. When you look at the total 3 to 5 year opportunity, by the time we're done, and then this is likely the time that I'll hand it back to Keith, in that year 5, when the wires cross in that second liquidity event, that's really when we're into that generational wealth. But Keith, this probably lends itself to then talking about how you all have already positioned the business owners here to accept that liquidity in a really advantageous manner. And maybe that's the best time to hand it off.
Yeah, thanks, Tim. Could I trouble you for slide 5? Because what I'd really like to do is show visually the way that all of this advice comes together into a single strategy. This is that family bank strategy slide. Because it's not just, strategic alignment with your advisory team is not just a nice to have. It's truly powerful, and it's extremely valuable from a tax perspective, right? I know we're running up on time, and I'll spare you the intro to the estate tax. But the bottom line is anything over 23 million in your estate, including houses, business ownership, all of that, over 23 million gets taxed at 40%, typically when you die or your spouse dies, the later event. Very inefficient to hand someone, your heirs, $100 million and have your first challenge for them be to pay a $30 million tax bill, particularly if the interest is illiquid. And so if you actually create a family bank structure, which is, a complex entity, but think of it this way, that's how when you go from entrepreneur to investor, you can become the bank. A lot of people will seed that with rollover equity. They'll put 2 or 10 or $20 million in that. And then 4 or 5 or 6 years later, when they exit, that $5 million might turn into 20. And now all of a sudden, if that's already outside of your estate, anything that you do in that, equity ownerships and new ventures, businesses that you want to be on the board of, but not the operations guy or gal, that's a great way to be the bank, make loans to those businesses, and charge up your spread, for what you can borrow for. We're showing SOFR plus 175 here, just for purposes of illustration. You can add a % to that, and it's going to be less than that business can get on a commercial facility. And then all of a sudden you're directing cash flow to the family business that you could take as a salary, and now you're funding your lifestyle from actual engagements and investments that you've made directly, not from stocks and bonds. Those are still growing until they have a dedicated home. So we've seen a lot of people be very successful with this, both in saving estate tax and also planning for what does retirement look like when you still want to be active in the community. You just don't want to run something in terms of the day-to-day operations.
That's outstanding, Keith. And I think that does a great job at really putting a bow on this entire conversation and really why we're having this conversation, why, why being a little preemptive, in an exercise like this opportunity and how it can have a meaningful impact, not only to yourself, but your family as well. With just the last few moments that we do have a few questions here. And Craig, this may be a good one for you. What specific industries are you seeing that will have the most targeted PE buying activity for 23 and 24?
Yeah, excellent question. I alluded to it a little bit earlier. These are businesses that are less cyclical to the overall economy, are recession-resistant businesses. We're careful not to say recession-proof because everything is affected in those types of circumstances. But certainly, it's industrials, and industrials think niche manufacturing, think some type of IP around your manufacturing process, or what I said earlier of having a moat around your business, having those competitive advantages. Service-based businesses are huge in on Wall Street today. Those are HVAC, plumbing, electrical, lawn care, pest control, pool maintenance, exteriors, roofing, right? So everything that goes into the home, this has been an investment phenomenon that has really taken shape over the last, HVAC's role has been over the last 8 to 10 years, call it, but particularly accelerated over the last 4, and more importantly, accelerated over the last 3 since COVID, where everybody was spending time at their home and investing in their home. You're still seeing it today. You have home builders that are out there now ensuring that ensuring that an office is a dedicated space in the home. That used to never be the case. And so having a home office is critically important. So the spend that goes into around your home from a services perspective is what investors are really focused on today. Think about it this way: like if your HVAC goes down or you can't heat your home in the winter time or summertime, you don't care if there's a recession or not. You want that air conditioning, if you live in the Sunbelt states, or if you live in the Northeast or northern states, or even out west in the wintertime, to have that that heater going, right? So that's critically important. And then also healthcare, right? So physician practice management. So these are your physicians, your primary care physicians. That's a massive opportunity for investment today. You're seeing a significant amount of investment from the likes of Amazon buying a primary care business for billions of dollars, and Walgreens and Summit Healthcare. CVS and Cigna are coming together too. So you have this cohort of very, very highly profitable and very strategic dollars chasing the healthcare space and healthcare IT, right? And also providing opportunities for pharmacy benefit managers to provide greater access to prescriptions at a lower cost. And then the last I would say is business services. Business services, think your IT. If you run a business, your IT managed service provider, MSPs. If you hear that acronym, it just stands for managed service provider. It's a huge buzzword on the street, and people are looking for that subscription-based recurring type of revenue that you need to have your IT or your cybersecurity person working for you around the clock, despite if we are, faced with some type of uncertainty ahead. So think recession resistant, less cyclical businesses to the overall economy are really the ones that are flourishing today and will continue to flourish despite, what we see of choppy waters ahead. I wouldn't say, massively turbulent waters, but I would say choppy waters ahead, which is great for business in the long term plan of things. And it drives competition, right? I think we were talking about it earlier here in the office that complacency, is in lacks competition, right? So if you're just, status quo, you're not really, if you're standing still, you're not progressing, right? And so, choppy waters and turbulent opportunities give you the opportunity to, do deals and do deals at the appropriate structure and be able to, optimize your business for the next level of growth.
Craig, that's really, really helpful. And I think really to kind of bring today's discussion full circle, there may be some additional questions out there in the crowd. Well, Tim, this all sounds great. How do I even start, this step? How do I even get engaged? And I know from an Align perspective, and as we wrap up, because we're against a hard stop here, at an Align level, we're very consultative. We love educating clients, and we do so before we ever, formally engage with agreements. We'd love to have a conversation. We'd love to learn more about you, your family, and your business, and what you've built. And we'll go ahead and put together a project valuation on the opportunity, and at least use that as a placeholder for you to then start planning and go, okay, well, this is the potential opportunity for my family. And what that can actually lead into from a wealth perspective, and the folks at BNY, of Scott and Keith, and how they can leverage that data to really start to build a model for what the rest of your life can look like. And I think going forward, please do not hesitate to reach out to our team. We'll be sure to distribute contact information so that can be easily accessible. And at the end of the day, we want to just help, support, and educate. And if we're doing that, we're doing our job here within the community.